All right, so we should be live. Hello, everybody. Welcome in, and thank you all for taking the time out of your busy days um, to join us today. My name is Tom Anderson. I'm one of the newest financial advisors here with Hendricks Wealth and Estate Management. On screen with me today, I have some of our other fellow advisors on staff, Dan Leitner, Jim Madel, and owner Jim Hendricks. So going into things, I'm 25, and like a lot of people, my age and in my generation, I've seen firsthand how confusing and overwhelming money can feel, especially once you get to that point where you feel like you've finally gotten decent at saving, but you're not quite sure how to take that next step. So today's seminar, the focus of it is exactly that, how to go from being a saver to an investor. And we'll talk a little bit about what that means, how to get started, and how to do it in a way that actually fits your life and your own individual goals. Um, and if you have any questions during the meeting, there's a Q&A button down in the bottom of the meeting. And so feel free to ask anything in there. And at the end, we'll have some time to respond to those and um, respond to any questions you guys might have. So without further ado, let's jump in to the content. So the goal today, my goal today is not to sit here and overwhelm anybody with fancy finance jargon or any complicated charts or things like that. It's really just to make things simple and practical and start from the basics. Um, we'll talk about what separates saving from investing, why timing of when you start matters so much, and some of the first, what those first steps look like if you've, you know, been a saver and are looking to go towards that investing mindset. Um, and just as important, we'll look at what not to do, mindset traps and mistakes that we see people make all the time and that can hold individuals back from real opportunity to grow. So here's kind of how I like to think of financial growth. It's kind of like almost leveling up in a game. So if you look at it like levels, the first level that you might have found yourself at is saver. This is a great spot to be. You're finally learning how to control that cash flow, starting to pay down your debts, um, and maybe getting to a point where you're starting to build up an emergency fund. The next level then is investor. That's when your money can start working for you instead of just sitting there in a savings account. Um, and then comes in builder. This is the point in your financial um, lifespan where you're optimizing that portfolio. You're balancing things like taxes, risks, and weighing out what are your future goals. And then the final level, which we all aspire to be someday, uh, is freedom. That's pretty much where your finances in life can give you choices instead of maybe being a burden on you. This is where you get to pick things like what do you want to work on, where do you want to live, how do you want to spend your time. And a lot of people find themselves stuck between that saver and investor point. They save, but they're just not sure how to get going on investing. And that's really what we're trying to look at today with this webinar. So, saving and investing. When we talk about saving versus investing, it's really not one or the other. You actually do need both saving and investing. Um, it's just that they do different jobs. Saving, this is for security. This is like your cushion for, your emergencies, your short-term expenses. Maybe you have a near-term goal, like saving for a vacation to Maui, or you want to buy that new car. So this is where savings can be, an important thing and really need to be um, a part of your finances. And then when you get over to investing, this is where you start talking about growth. And this is how you build wealth for the future. The money that you don't need in the short term can be working harder for you through things like investments. Um, and if all your money is just in a savings account, I mean, you're playing defense, which defense does win championships, of course, and you're keeping what you have safe. but you're not scoring any points. So to set yourself up for that financial success long term, um, moving into that investing sphere can really help you get to those goals. And so one side that I've talked about before is the power of time. And this is really one of the most powerful concepts in all of finance in general. It's compounding. Compounding is when your money earns returns, and then those returns start earning returns. It's growth on growth. Um, just a quick example here is if you were to invest $300 a month starting at age 25 and earn roughly about 9%, or what the S&P 500 has averaged over the last 20 years, that $300 a month will turn into about $1.5 million by the time you're age 65. If you wait just 10 years to start at age 35, that same 1.5 million will turn into about 530,000, or just under a third um, of your nest egg at retirement. So that's really the power of time. 10 years can make a huge difference, not just because you invested more money, but because you gave that money more years to compound. And it doesn't have to be all at once either. Starting small is definitely better than not starting at all. So even if you're not in the spot to put the amount of money that you eventually want to be, setting aside for retirement, starting now still gives you a lot better footprint than starting later. Um, and starting early does give your money more time to grow, but remember also, it's never too late. Whether you're 35, like in the example, whether you're 25, 35, 45, 55, or even if you're starting now at 65, maybe you've been saving your whole life, you could still make meaningful progress long term. And while this example, $300 a month, might seem high, it might seem low to you, everyone's situation is different. So really, your own savings path and your investment path, these all look unique to you, and it really just depends on your own goals. So understanding risk. When you start investing, it's normal to worry about risk. It's scary. Investing is scary, and any risk behind your money in your portfolio, that's scary. But the key is understanding what kind of risk that we're talking about, and that's what matters. So when we talk about volatility just measures how much an investment's price moves up and down over time, and the swing in value that certain investments have, that doesn't necessarily mean a loss. It's only a loss if you sell at a lower price than what you bought. Long-term investors, we can see often riding out these ups and downs, and that volatility doesn't mean as much because the longer your time horizon, the more risk you can afford to take, really. Um, like over a 5-year period of time in the market, historically, it's almost always been where the stock market goes up after that 5 years. So if you're in the market for longer, that time horizon allows you to take more risk. And being diversified or spreading your investments across different kinds of assets, this will help you manage and maintain that risk. And it'll keep you in line for that potential long-term growth that you might get from investing. And so then the investing basics. The basics of investing are pretty much your building blocks that you could set up um, yourself with to start learning about investing. And you don't have to be a Wall Street expert or a financial guy or a financial advisor to start investing. I mean, a simple breakdown of these, and when we start talking about things like stocks are basically just a small piece of ownership in a company, and they offer potential for growth over time. There really are so many to choose from, and there's not particularly a right or wrong answer here for which one you want to be in. Just make sure you're not putting all your eggs in one basket. I know that many of you might love shopping on Amazon or Target, and you might like that. You might think that Amazon is going to be the best company in the world for the next 20 years, but leaving all your assets into one company is just too large of a risk, and that's why we like to preach diversification when we start talking about investing. And next up in an investing portfolio might be bonds. Bonds are basically just a type of loan where you are the one lending money to an issuer. Basically, sometimes this could be a government, might be a corporation, a business, and you loan them the money for a set period of time, and they'll pay you interest for that said loan. And these provide some stability and income, and they can be used for a more conservative form of investment, which we find putting people in. And next up is funds and ETFs. So mutual funds, index funds, ETFs, these basically put together a variety of combinations of all these investing portfolios or sectors, and they put it all into one investment, so you're automatically diversified. And there are many different kinds of index funds, mutual funds, ETFs across every sector and every category of investments. So sometimes you're even wanting to diversify which funds you have. And then where you invest that money matters too. There's retirement accounts like 401ks, IRAs, Roth IRAs, and these can all offer powerful tax benefits that can further that investment potential from a long-term perspective, depending on which one of them you invest in. And each account has its own benefits, and finding one that works best for your situation can help you save or maybe even earn more over the long term. And really, you don't need a perfect plan to start investing. I know it's scary, but the biggest thing is just that you start. Um, you could start with a goal. Figure out why it is that you're investing, whether that's wanting to save for retirement, whether that's wanting financial freedom, future flexibility, or anything really that motivates you. Looking for a goal is a good first step. And then you can go on and eventually start to automate it. You can set up automatic contributions so that all this happens on autopilot. You set it, you forget it, it happens in the background, and you can slowly start building for an investment portfolio. And then remember that consistency beats timing. You're not trying to worry about picking the perfect day or the perfect month to get in the market. The people who normally do best long term are the ones who just stick with it and not try to time the market or beat it. Um, and finally, just giving yourself permission to learn as you go, not having to know everything before you get in is fine. You can learn, you know, maybe you can make a mistake and you learn from it and get better. You don't have to be Warren Buffett to get into investing. You can start where you are and you'll learn more as you invest more. And then here's some traps that we see all the time. The first one being, which we kind of just touched on, is waiting for the perfect time. There's always going to be a reason to wait. There's market fluctuations, things with elections, news headlines every day scare people out of it, but waiting is really what costs people the most in lost compounding. Some of the largest single day gains in stock market history happened during the times of some of the most extreme volatility. Uh, five of which happened even during the Great Depression. So really, just there's never a perfect time to get in other than today. And then another common mistake is taking advice from social media. And you can hear things on, TikTok, Reddit, Twitter. And while these things might be entertaining or like, whoa, I could do that, um, there's not really a perfect thing that fits everyone's situation. And you might see someone post about the next get rich quick, 100% profit stock on their favorite platform, whatever you subscribe to, and then you think that since they did it, it's going to be the same for you. I can get 100% return in a month. Um, but often this can lead you to higher losses and losing a sizable portion of that investment that you're trying to grow over time. This has happened many times where somebody has the next big thing. Another thing is ignoring inflation. If you leave too much of your money in cash accounts, bank accounts, um, earning just a marginal amount of interest, that means your purchasing power shrinks every single year. Your cost of living keeps going up, but if your balance in your account doesn't, by themselves, that inflation is going to start affecting you personally. And then skipping an emergency fund, a great rule of thumb is just to have a couple months of expenses. Sometimes we say 3 to 6, depends on the person, in savings, just to keep you from pulling money out of your investment accounts during tough times. And then this is where the real transformation happens. It's all about mindset. Investors think long term, and they have to know that building wealth isn't about quick wins. It's about time in the market and consistency. And eventually, your money should be working harder than you do. And that's the goal, is just to create that financial freedom that we're talking about, not just financial stability and getting by. And remember, progress matters more than perfection, and even small steps, as long as you're consistently taking them, they will move you forward. And so the next steps, as your life changes, you might get a job promotion, you might buy a house, start a family. Things like your financial strategy should also change with those life changes. It's a good idea to always revisit your goals, because goals change. You might have a completely different outlook on life year in, year out. So making sure that your investments also align with your goals should be a priority for you as well. And if you're not sure where to start, that can be where we come in. Working with an advisor means that you have a guide who can help you plan, not they can help you plan it strategically, not just on an emotional standpoint. And so that is most of my presentation. So thanks for following along, and we're going to open up the Q&A now. So if you have any questions, feel free to drop them down below in that Q&A section, and one of us will answer that question. And if you have interest in attending any more of our webinars, we have these every week. We will be moving them to 12:30 Eastern time, or another set at 1:30 Eastern time, to accommodate some of our Florida residents. But a whole list of those webinars is on that www.hendrickswealth.com. And I can't really see the Q&A, so if there is any, one of the
No
members.
questions yet. No questions yet, Tom.
Okay.
Good job.
Cool.
Thank you for a great presentation. And like Tom said, we will not have a presentation next week, right before Thanksgiving. However, we'll pick up again on December 3rd with how to make an inheritance last. And then the weekend after that, or the week after that on Wednesday, Jim Hendricks will be speaking to strategies, year-end financial strategies. So we do have a question here. How do we get from investor to builder? Is there an amount that matters? I feel that I have to be a millionaire to make that work.
There's not really a particular amount. I mean, if you're talking, investor to builder, a good step is just to keep investing. And it's different for each person to what their own personal goals are. Somebody could be perfectly set for retirement with, let's say, 500,000, and some people might take 10 times that to be in a comfortable spot. So really, it's just depending on what you consider that to be. Some people could be 1% of what other people are. So it's really different for each person. And talking to a financial advisor like us, or somebody in the industry, can be helpful just to figure out where along that path you are. It's really, there's no right way to say that it's for everybody is the same amount. It's not. It's different for everybody. Everyone's going to have their own spending habits in retirement. They're going to have their own, spot that they feel like they're financially free, or if they're financially set. So that can be where, somebody like us can come in and help walk you through how far along in that path in your financial journey you might be.
Absolutely. When we build retirement plans here, No two are the same. Every person out there is a little different, and we customize strategies to fit your specific needs and wants and goals.
Could not agree more.
All right. I do not see any other questions coming in here, so I will let you sign off then, Tom.
All right. Well, everybody, thank you for spending a part of your day here, and really you're ahead of most people just by showing up and learning. So feel free to reach out to us. If you want to request a free consultation with us, you can either email that info@hendrickswealth.com or call our office line or go to our website, and we'd be happy to go over anything might be with you. But thank you guys for stopping by, and hope to see you in a couple weeks.
Take care,
Thank
everyone.
you.